Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So, this brings us closer. I am able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. The need for a risk reset. Every portfolio carries a certain risk profile within it. Every portfolio is positioned to carry a certain level of risk. This level of risk keeps changing because valuations change, and when valuations change, stocks which you bought perceiving them to be low risk become high risk. The valuation becomes the risk. When many stocks in a portfolio become excessively valued, the portfolio carries a higher risk. Remember, this could be a portfolio that you curated and created as a low risk portfolio. What happened in the buy at any price portfolios is precisely this, and this is not something specific to that investment style. This could happen to every one of us in our portfolios. As a manager of portfolios, be it my own personal portfolio or a professional portfolio, I constantly evaluate the risk in the portfolio in line with the market context and keeping in mind the valuations of individual stocks in that portfolio. So from time to time, we check if the risk alignment is reasonable. Wherever we find this risk alignment to be unreasonable or not worth carrying, we reduce the risk. Effectively, we reset the risk constantly in our portfolios, be it my own portfolio or portfolios that I professionally manage as a PMS manager. Now, where are we today? Many people get confused when I talk about risk because they think that all portfolios carry the same level of risk. In portfolios that I curate or manage, I tend to keep the risk lower in times like the present. So, the beta in that portfolio in the present will be lower than the market beta, and I ensure that valuations are not going to hurt the portfolio too badly when they become excessive. So, the portfolio is already reset, and if due to factors beyond my control, beyond all our control, the markets fall due to global macros, US sentiment, the portfolio risk will not be a cause of excessive worry. In fact, they would not be a cause of worry itself. By positioning ourselves like this, we want to be confident that our investors, me included, can invest when that opportunity in the form of extreme volatility presents itself before us. So, this preparation is what I call as a risk reset. It's not something that any of us cannot do, every one of us can do it. But as a manager of a portfolio, I feel that it should always be done before the event. You cannot do a risk reset after the event. Most people are reactive in the way they reset the risk. I believe it is our duty to be proactive in doing this reset. So what this would mean to my own portfolio or the PMS portfolios is we are now ready for a correction. If there is a correction, we know what we need to do. What do we need to do? We need to keep some powder dry outside the portfolio, which we can invest into the portfolio. Many people ask this question, why can't you sell the portfolio and keep cash? Now, if the risk in the portfolio is not excessive, selling stocks unnecessarily can at times make us exit a position because somebody else may be smarter and buy and not let us buy the stock again. So it will be too close a call. I would like to avoid these close calls simply for the reason that if you get out of a stock at a valuation where the risks are not too much, simply to keep cash in your portfolio, chances are you will be like a batsman who got run out. And that is something that we need to avoid in any market context, which is why I always tell my clients and myself, keep some money aside. Find some money outside your portfolio which you can invest into the portfolio when the markets correct. Because already your portfolio beta is lower than the market. If the market falls, then your beta is more favorable to you. You can take risk at that time. And when I say take risks in a market fall, I don't mean to say that you must pump in hell of a lot of money. You don't need to do that. Even if you can't find big money, even those small sums of money, which could be anywhere between 5 and 20% of your portfolio value, can make a huge difference to the long-term outcome in your portfolio. So, as such, the portfolio is traveling with a lower beta. The risk reset is already done to a decent extent, and when the market corrects, you can go ahead and do your investing and not worry about the risk in your portfolio. This is where the activity of a risk reset becomes very critical for every portfolio. Now, if you are an individual investor who is managing your own portfolio, if you do this before the event of a market correction happens, you are well placed to participate in that correction. What I have said till now in this video is reasonably simple, but a lot of people confuse what happens in the broader market to what's going on in their portfolio. They see what narrative and commentary is there on the broader market in the public domain and try to extend that into their portfolio. My simple explanation is it may not apply accurately to your portfolio because your portfolio is already conservatively managed. However, if you manage a portfolio which is very momentum driven, unlike what we do, and if you are chasing the stocks which are the flavor of the day, then you will not be in the same level of comfort. You need to create that level of comfort before a correction, and you need to do it quickly. Some people are nimble and they may manage to do it, but if you are managing a large sum of money, you will not be able to do it, and you will essentially go down with the market wave. So the market wave comes down very fast, your portfolio will also come down fast. Maybe if the wave rebounds, you will also go up with it. Effectively, you are like something that's floating on the surface of that wave, and sometimes the wave itself can hurt you. A risk reset is essentially meant to avoid getting hurt by the market waves, and as we see it, the markets are going to become very choppy like the high seas. And as we see it, the markets are going to become extremely choppy, and it's important for you to protect yourself from a nasty wave. That is what makes a market analysis, a portfolio analysis, and an alignment of risk and a reset of risk completely needed at this hour. I hope you got the essence of what I spoke, and I hope you align your risks correctly so that you are well positioned for a market correction. Thank you for watching this video.